Welcome to the Deep Dive. Today is Wednesday, January 14th, 2026. And if you have any exposure at all to the metals market, or frankly, if you're at all concerned about the fundamental value of the currency in your wallet, you are watching a financial event of truly historic proportions.
You really are. We're not just talking about a big move on a chart here. We are witnessing what I think is the market movement of a generation, and it's being driven by the realization that a 50-year illusion has just completely shattered.
That illusion being what exactly?
The illusion was the fundamental belief, the operating principle of the Western financial system, really. The idea that the price of strategic physical assets, like silver, could be determined purely by algorithms, by leveraged derivative contracts, and by the seemingly endless supply of paper short positions in New York.
And today, the scoreboard is just telling a completely different story.
Yes.
It's the story of physical reality completely overwhelming that paper fiction. The paper price right now, as we're talking, is flashing $89.67 an ounce.
And that's up another $4.50 just today. I mean, think about that. That's a blistering, completely vertical 5% move, and it's knocking right on the door of $90.
What makes this so significant, though, is the context. This isn't happening in a vacuum. This intense volatility is coming right on the heels of yesterday's pretty dramatic failure, what some traders are calling the failed assassination attempt.
Right.
Let's unpack that right away.
Yeah.
For everyone listening, what exactly was the establishment's move yesterday? And, why did it fail so spectacularly to stop this rally?
Well, the establishment's primary tool, their go-to weapon to cool down our runaway futures market is a margin hike. It always has been.
Right, they just make it more expensive to play the game.
Exactly. A margin hike forces traders, both long and short, by the way, to post more collateral, more cash, essentially, to maintain their positions. So if you're a weak or a highly leveraged holder, this move forces you to sell your position.
Which then drives the price down and kills the rally. It's a way to artificially create a panic sell-off.
Precisely. And they did it. They raised the margin requirements significantly yesterday, betting that all this bullish momentum was just, speculative leverage. But what happened?
Nothing. The volatility continued, and the price rocketed even higher today.
Which means the buyers of silver today are not weak, leveraged speculators. They're powerful entities. Whales, sovereigns, massive industrial users, and they are taking physical possession. They're operating with huge amounts of capital, and they're prioritizing getting the actual metal over any short-term paper profit.
So the margin hike failed because the conviction in the physical market is now just completely overwhelming the paper mechanism.
Yeah.
That single failure yesterday, it seems like it gave the green light for today's insane move.
It absolutely did.
And what's so fascinating here is that the systemic crisis, it's not subtle anymore. We have three undeniable, almost forensic facts that prove this absolute divergence between the paper fiction and the physical reality.
Right. And to set the mission for this deep dive, that's what we're going to do. We're going to dissect these three pillars. They are all connected, and, they collectively confirm the central theme of this whole move. The U.S. dollar is fundamentally failing as a reliable store of value when compared to strategic physical assets.
And those three facts, in what seems to be chronological and escalating order of panic, are: first, the U.S. Mint's emergency closure, which we're interpreting as a sovereign default on its physical supply obligations.
That's a big one.
Second, the massive coordinated drain of over 1.3 million ounces from J.P. Morgan's vaults. We're calling that the whale offensive.
And third, the historic, just mathematical proof of the $11 arbitrage gap between the New York price and the confirmed physical price in Shanghai. That's the ultimate reality check.
So the government blinked, the smart money attacked, and the price discovery mechanism just completely broke.
That's the story. Let's unpack the implications right now, and we have to start with the highest level of systemic shock, the government's official confession.
Okay, let's start there. We begin with the official communication that came out from the United States Mint, the sovereign entity, responsible for producing constitutional coinage, primarily the Silver Eagle. They have officially suspended all sales of silver numismatic products. Now, to a casual observer, that might just sound like a minor operational note. Why is this being seen as a five-alarm fire, a confession of systemic failure?
It's a confession because it involves a sovereign entity failing to fulfill its most basic mandate, which is to exchange its currency for its strategic assets at the price it states. The official excuse, as noted in their communication, claims the suspension is due to pricing adjustments.
Pricing adjustments.
Right. They're saying that the rapidly rising silver prices have forced them to pause operations until they can figure out how to accurately price their products.
Wait, hold on a second. If they're backed by the United States Treasury, why can't the U.S. Mint, which has, basically unlimited access to capital and advanced trading systems, why can't they just update the price of a 1-ounce coin in real time? I mean, this is explicitly not a technical glitch or some website error. So why does this rise to the level of a physical default at the sovereign level?
It's a really crucial distinction. The reason this signifies such a deep systemic crisis lies in this concept of bureaucratic paralysis meeting hypervolatility. Think about the paradox here. The U.S. Mint is not meant to be a day trader. It's a manufacturing entity. Its core directive is to produce coinage, which historically has an inherent value based on the underlying metal, plus a mandated fee or, a premium.
And if the volatility with silver moving 5% today, maybe 10% tomorrow, has exceeded the capacity of their massive government bureaucracy to simply adjust a few prices, it shows that the speed of the market has just paralyzed the entire operation.
Exactly. They are legally and administratively structured to handle slow, predictable moves. When the price begins moving vertically, like we're seeing right now, their internal accounting systems, their legal mandates for pricing, their agreements with wholesale suppliers, they just freeze. They simply cannot process the change fast enough.
But the deeper implication, the more profound one that you alluded to, is about replacing their inventory. When any entity stops selling something during a price spike, it's because they're afraid they can't replace what they sell without taking a huge, probably immediate loss.
That is the absolute core of the default. Let's just run the scenario. If the Mint sells a 1-ounce Silver Eagle today for, say, $95, that includes the $89 spot price plus their premium, they take in $95 worth of dollars. But by the time they get back into the wholesale market to buy a replacement ounce to mint, the spot price has already jumped to $110.
So they've suffered two critical losses there.
Two. First, the dollars they just received are instantly depreciated against the strategic asset they sold. And second, and more importantly, they have lost the physical ounce of silver itself.
And if they can't go into the wholesale market, the COMEX or the refiners, and buy that ounce back because the refiners are empty or because the metal has been sucked away by higher bidders, they're effectively liquidating national wealth for a depreciating paper currency.
This is the moment of clarity. This is the core statement. The U.S. Treasury, through the Mint, has realized that the silver is worth more than the dollars. They would rather physically hold the strategic atoms than take the cash, because the cash is now seen as an increasingly worthless political liability.
Yeah.
They've abandoned their own pricing mechanism.
That is just a staggering realization. This suspension is the break glass in case of emergency signal, and it leads directly to what the sources are calling the no-offer phase. We've gone parabolic, and the largest seller in the entire nation, the sovereign entity itself, has just abandoned the field.
I mean, use the analogy again because it perfectly captures the gravity of this currency failure. Imagine you walk into your local grocery store and the clerk is refusing to sell you basic things like milk or eggs or bread. You ask why, and the clerk says, "Sorry, the price is rising too fast. Corporate has suspended all sales until we can figure out what to charge next."
The implication isn't that they're sold out. It's that they refuse to accept your currency for their goods because they know the cash will buy less tomorrow than it does today.
And the government, by closing the Mint, is giving us that exact same confirmation about the U.S. dollar.
Wow. And the psychological shockwave this creates across the entire dealer network has to be immediate and profound. All the major private dealers, APMEX, SD Bullion, JM Bullion, they use the U.S. Mint supply and pricing as the bedrock for their own operations, especially for Silver Eagles, which are the benchmark coin for the entire world.
So when the Mint slams its doors shut, those dealers realize their primary source of the most recognizable, most desirable product is instantly cut off. Their future inventory is just gone, zeroed out.
This immediately creates that devastating scarcity loop we're seeing right now. Dealers have to ration their remaining inventory to protect their capital and manage their future risk.
Which means premiums on Silver Eagles are crossing huge thresholds. They are now completely untethered from that $89 spot price. The street price for a physical Eagle is likely already near $110 or maybe even $120, even if the paper price on the screen says $89.
So the spot price is becoming completely irrelevant to the actual cost of getting your hands on the physical metal.
Exactly. And the profound irony here is that the U.S. government has, completely inadvertently, launched the biggest marketing campaign for silver in history. By telling the public, this strategic asset is so valuable we can't afford to sell it for our own currency, they confirm silver's status as the ultimate store of value.
And that demand doesn't just disappear. The hundreds of thousands of ounces the mint would have sold just becomes pent-up demand, and it spills over everywhere else.
It spills over into every other silver product available, rounds, bars, investment contracts. It creates a vacuum effect across the entire system. And when the mint does reopen, which they will have to do eventually, we know the price will be substantially higher. They'll be repricing for a post-$100 world.
So this event, the closure of the U.S. Mint on January 14th, this is the demarcation line. Before today, you could say this was a severe supply squeeze, maybe driven by retail. After today, it is officially a sovereign crisis.
It is. The government entity that prints the money can no longer get the metal it needs to mint its own constitutional coinage.
Okay, so that's the defensive move by the government, the paralysis. But we need to look at what was happening at the exact same time in the commercial market. Because while the government was hiding the metal, the biggest players in the world were actively taking it.
Yes.
Let's move to that, the aggressive action taken by the biggest players.
The transition here is, it's just so crucial. We move from the defensive paralysis of the government to the coordinated offensive aggression of the smart money, the whales.
Wow.
While the retail side was being denied a single coin, a massive entity, or maybe a coordination of them, was conducting a physical bank run on the wholesale side of the market.
And the scale of this is, it's truly staggering. We looked at the daily depository statistics from the CME Group, and they confirm what our sources are calling a coordinated raid on JP Morgan Chase's stockpile. For years, JPM has been the fortress, right, holding the largest vault, serving as the primary backstop of the whole COMEX system.
That fortress was breached, and the numbers are precise. 1,302,870 ounces of silver were physically withdrawn from the JP Morgan vault. And let's be clear, this wasn't an accounting trick or some paper transfer between entities. This metal was loaded onto armored trucks, and it left the COMEX ecosystem entirely.
Over 1.3 million ounces in a single 24-hour period. To put a physical scale of that number, our sources calculated that as roughly 40 metric tons of silver. That's about the size of a shipping container just leaving the banking system forever. It's a huge logistical undertaking.
And this bleeding, it wasn't just localized to JPM, it was systemic. It was across the entire network of COMEX depositories. We saw 600,000 ounces withdrawn from the Brinks vault, 200,000 from the CNT vault, another 259,000 from Loomis. The total COMEX loss across all of them was nearly 1.8 million ounces. In a single day. This is the very definition of a physical bank run.
And this requires not only immense capital, you're buying metal at $89 an ounce, so that's nearly $160 million in one day, but also the logistics and the organizational power of a major government or industrial entity. This is not a small hedge fund.
No, it has to be a whale.
Ah.
A sovereign wealth fund, a central bank, maybe a massive industrial conglomerate that needs this metal for its future operations. And the key question is motivation. Why are they taking physical possession now at what many people would call a near all-time high of $89?
Right. Why not wait for the dip that the paper market always promises coming?
Because they fear one thing above everything else: counterparty risk. The smart money knows that the paper price flashing at $89 is vulnerable. They're afraid that if they leave their metal sitting in a bank's vault, it will be encumbered, leased out, or, most critically, rehypothecated to cover the massive underwater short positions held by those very same banks.
Okay, for the listener, let's quickly define that loaded term, rehypothecation.
Rehypothecation is basically when the bank uses collateral that you own, the silver you pay them to store, to secure its own liabilities, often without your explicit knowledge. It means if the bank fails, your stored metal might not actually be there for you because it's tied up covering their losses.
So these whales are just following the golden rule of this environment.
They are. If you don't hold it, you don't own it. They're moving their wealth out of the banking system entirely. They're prioritizing possession because the trust, the institutional trust, has just collapsed.
And that focus on institutional trust brings us to maybe the most significant technical detail of this whole drain, the distinction between registered and eligible silver. You mentioned the bulk of the JPM withdrawal came from the eligible category. For listeners who haven't tracked these daily reports, can you remind us why the eligible metal leaving is so much more critical than registered stock?
This is where the long-term prognosis gets catastrophic for the COMEX. In the exchange system, registered silver is the metal that's been designated by its owner as available for delivery against futures contracts. It's, actively for sale.
Okay.
Eligible silver, on the other hand, is privately owned metal held purely for storage. We're talking central banks, sovereign wealth funds, massive family offices. It's considered sticky because it's owned by long-term holders who are paying storage fees, often for decades. It's wealth protection, not speculative trading stock.
So when registered metal leaves, it just means a trade was fulfilled. When eligible metal leaves, it means an owner has lost faith in the custodian.
Precisely. And the sources confirmed that while registered stocks did drop by a large amount, over 500,000 ounces, that monumental 1.3 million ounce withdrawal from JP Morgan came predominantly from the eligible category. This means the old money, the long-term, entrenched holders, have decided the COMEX is no longer a safe place to store their wealth. It's a vote of no confidence in the entire institutional structure of Western price discovery.
And if they're moving 40 metric tons out of the JP Morgan vault, where is it going? I mean, we can connect this back to the global price map, right?
It's almost certainly heading across the Pacific. The 1.8 million ounces that left the COMEX yesterday are being driven by one single force: the arbitrage trade. They are moving metal from a market that suppresses the price New York to a market that pays fair value Shanghai.
This physical drain creates an undeniable mathematical limit on how long the price suppression can even last. The banks can, in theory, print infinite paper shorts, but they have a finite and now rapidly dwindling physical inventory.
This rate of withdrawal, nearly 1.8 million ounces a day system-wide, the remaining available inventory in the registered category on the COMEX is going to hit a critical, unrecoverable level very, very quickly. We are talking about a potential default, where they just can't meet their delivery obligations within a matter of weeks if this trend holds.
And that potential default forces us to connect right back to the mint failure. The mint can't find silver to make coins because the wholesale metal is being hijacked by these massive withdrawals from the vaults.
It's the ultimate crowding out effect. The retail supply chain is downstream from the commercial vaults. The big fish, the whales, the sovereigns, the industrial buyers, they're draining the river dry. They are securing the atoms needed for the green economy before that water even reaches the retail buyers who are just trying to get their hands on a single silver eagle.
So the JPM drain is the undeniable proof point. It confirms the smart money isn't selling into this rally. They don't see $89 as a peak. They're taking delivery at near all-time highs, which proves they believe this price is cheap. They're preparing for a massive repricing event that makes today's move look like a minor adjustment.
Absolutely. When you see massive capital expenditures and logistical efforts dedicated to moving metal out of the banking system at the current price, you know the ultimate destination is much, much higher. They are exiting the dollar system and locking in their wealth in the physical asset.
So we have the government hiding the metal and the banks losing the metal. Now we have to analyze the single data point that forces the entire Western paper system to change, the true price being paid on the other side of the world.
Yes. Now we arrive at the immutable reality of physical market physics. If you look at your screen, you see the COMEX paper price, $89.67. But we have confirmed data from the physical markets in China, specifically the Shanghai Gold Exchange, that proves this number is, well, it's currently a lie.
So what are the confirmed prices in the East right now?
The confirmed transactional physical price for silver in China is currently hovering between $98 and $100 per ounce. This creates an immense arbitrage gap of $11 per ounce.
$11.
$11. And let's be crystal clear. This is not a minor fluctuation or some inefficiency that will correct itself slowly. In financial terms, this is a broken market. Our sources are rightly calling it a vacuum or a black hole that is sucking every available ounce out of the Western Hemisphere.
An $11 gap is an enormous risk-free profit margin in commodities trading.
It's a risk-free money printing machine, and this is the physical physics of the trade. If you're a global bullion bank or a trading house, you execute this trade instantaneously. You buy a COMEX futures contract at $89, you stand for delivery, you load that physical bar onto a plane, the same bars we just saw leave the JPM vault, fly it to Shanghai, and sell it for $100.
That's a guaranteed low-risk profit of over 10% in just a matter of days.
And this arbitrage trade is the underlying mechanism that is draining the vaults and forcing the U.S. Mint to close. The metal is flowing uphill, defying financial gravity, because the money is just better in the East.
This trade signifies something far more profound than just a price difference, though, doesn't it? It signifies a historic inversion of price discovery.
It does. For 50 years, the global price of silver was set in New York and London based on their massive paper derivative markets. The West was the price setter, and the East was the price taker. They had to accept that price for their industrial needs.
And today?
Today, that relationship has completely inverted. Shanghai is now the price maker. They are setting the global floor based on physical supply and an inelastic demand for strategic industrial needs. Solar factories, high-tech batteries, and, increasingly, citizens just trying to protect their wealth against a weakening dollar. New York is now just the price taker, being dragged along by the overwhelming gravity of that arbitrage trade.
This leads to a mathematical certainty that just can't be avoided by any political or financial games.
It does. The COMEX paper price must rise to meet the Shanghai physical price of $100. It has no choice. If the paper price stays at $89 while Shanghai is at $100, that arbitrage mechanism will just continue, and it will lead to a complete physical drain of the COMEX vaults. The exchange will hit 0 ounces and be forced into default. So, to prevent total market failure, the COMEX has to close that gap.
And that inevitability explains why we're seeing these vertical candles on the chart and this extreme manic volatility. The Western financial system is frantically trying to reprice itself to the physical reality of Shanghai before the inventory runs out completely.
And we have to analyze why China is willing to pay $100. Why aren't they trying to manipulate the price down like the West does? They understand the inelasticity of their demand. China views silver not just as a financial asset, but as a strategic mineral. It's essential for them to dominate the green energy transition: solar panels, EV batteries, critical electronics.
So this means they're not speculating on silver. They are accumulating strategic national wealth.
Exactly. They are willing to pay $100, $110, whatever it takes to secure the atoms they need for their industrial future. They're hoarding, not speculating. And this makes their demand virtually inelastic. A high price doesn't deter them. It only accelerates their buying because they fear future scarcity more than they fear the current cost.
The Shanghai reality check now perfectly explains the paralysis we saw at the U.S. Mint back in Section 1. The Mint was effectively priced out of its own market.
That's right. They offered their suppliers the $89 spot price, and those suppliers instantly refused because they could get a 10% higher price, $100, by just sending the metal to Asia.
The sovereign government of the United States was simply outbid in its own currency market by the physical reality of the East.
The suspension of sales wasn't because of some bureaucratic inability to update a price tag. It was because they were unwilling to pay the real market price being set by physical demand, and so they got no metal.
This is truly a textbook illustration of what an early-stage currency collapse looks like. It's not just that the dollar number on the screen gets bigger, it's that the physical goods, the strategic resources essential for your nation's future, they disappear from your shelves because your currency is no longer accepted as a valid store of value by the producers of those goods.
We're watching a fundamental, stark bifurcation of the world. A crumbling paper world in the West, where prices are managed by derivatives, and a repricing physical world in the East, where prices are set by industrial necessity.
So what does this mean for the immediate price action? With Shanghai confirming $100, the psychological ceiling for New York is just shattered. New York traders know that $89 is a discount, $90 is a discount, even $95 is a discount because they have a guaranteed exit at $100.
And this creates a powerful, self-reinforcing feedback loop. Institutional funds that are currently underweight silver, and most major funds are now scrambling to get exposure. They flood the futures market because they can't get the physical metal fast enough, which pushes the paper price up, which generates headlines about $100 silver, which creates more retail panic, which keeps the mint closed, which raises the premiums. We are officially in the super exponential phase of a parabolic move.
We should also briefly mention gold here because it confirms the broader monetary context. Gold is holding its recent breakout at $4,616, confirming the generalized dollar devaluation.
But silver is dramatically outperforming gold, meaning the gold-to-silver ratio is compressing rapidly. The sources are absolutely right on this. Silver is running out of stock. Gold is just being revalued. The silver shortage is acute, driven by industrial and sovereign necessity combined with monetary demand. You just can't fake that $11 Shanghai spread. The price is not negotiable. It is dictated by the highest bidder for the physical atoms.
They held the beach ball underwater for too long, and now it's just rocketing to the surface. $100 is no longer a distant target. It is the current global market price. It's just unevenly distributed right now. We need to look forward now and map the path to what seems like inevitable triple digits.
We have to synthesize the evidence now because the three pillars we've just discussed, the mint default, the JPM drain, and the Shanghai $100 price, they're locked in. This confluence of events signals that the era of cheap, paper-derived silver is over. The financial rules have been permanently rewritten.
So where does this stop? If $89 is already a discount to the $100 floor being set by Shanghai, we have to prepare for the next psychological barrier. Is $100 the ceiling, or is it merely the starting line?
$100 is, without a doubt, the starting gun for the mania phase. For decades, silver has traded like a secondary commodity, right? Often stuck in the teens and 20s, perpetually seen as the poor man's gold. The idea of triple-digit silver felt like a fantasy to the average investor.
But with the Shanghai physical price now confirming that $100 is reality, that fantasy is just dissolving in real time.
When the COMEX finally gaps up to meet Shanghai, which is a mathematical certainty, and it's likely imminent, probably within the next 48 hours, it's going to trigger a global media frenzy. $100 silver is a headline that writes itself. It'll be on the front pages, interrupting the normal news cycle.
And this is where the market psychology just completely takes over. When the general public sees $100, they won't paradoxically think it's too expensive. They'll panic and think, I need to buy it before it goes to $200.
This is the infamous Giffen-Veblen paradox in action. As the price rises sharply, demand actually increases exponentially because the rising price confirms the underlying value in the scarcity. People see the price surge as validation that the system is breaking and that silver is the last safe haven.
And the U.S. Mint's closure just poured gasoline on that scarcity fire. By suspending sales, the government has given silver the ultimate endorsement, confirming that it is truly scarce and desirable. When the mint finally reopens, the demand will be exponentially higher, regardless of the price, just to secure a piece of that official coinage.
This moves the discussion beyond simple supply and demand and into pure monetary logic. The increase in the silver price is fundamentally about the dollar failing in real time. The $4,616 price of gold confirms the dollar's devaluation. The physical drain from the West confirms the distrust.
We are tracking a larger sovereign crisis here. We previously tracked that $50 billion bond sale by the Reserve Bank of India, which was a massive first domino in the sovereign bond market. The closing of the U.S. Mint is the second domino, now hitting the commodity market.
When a world power cannot borrow money cheaply in its own currency, and it cannot source the strategic industrial resources essential for its future, it is fundamentally losing its sovereignty and its control over its economic destiny. The ability to source and secure strategic atoms becomes more important than printing paper.
This leads us directly to the most critical question for our listeners: the exit strategy. When you see those triple-digit gains, maybe $150 or $200, the temptation to sell your metal for dollars is going to be extreme.
You have to resist that temptation. You have to ask yourself, what am I actually doing here? You would be trading a scarce strategic monetary asset, the ounces you labored to secure for an infinite depreciating political liability, the US dollar, the very same currency that the US Mint itself is struggling to price because it's failing so rapidly.
The strategy has to remain ounces to assets.
Absolutely. You hold your silver until the mania creates a profound distortion in the other direction, until silver's purchasing power is restored to its historical parity. And you only trade those ounces directly for productive cash-flowing assets. Land, a profitable business, cash-flowing real estate, or another tangible asset that can't be inflated away.
Right now at $90, silver is only just beginning to catch up to decades of monetary inflation. We are nowhere near the peak of purchasing power. I mean, to put that into stark historical perspective.
In the 1980 peak, it took roughly 800 ounces of silver to buy the average U.S. home. Today, even at $90 an ounce, it still requires thousands of ounces. We have a long, long way to go to restore that historical parity, which is the true definition of silver's value.
And then we also look at the geological ratio, the final piece of this puzzle. With gold at $4,600 and silver at $90, the current gold-to-silver ratio is roughly 51.1. Geologically, silver is found in the Earth's crust at a ratio closer to 15.1 against gold.
So if silver returns to that natural geological 15.1 ratio against $4,600 gold,
the mathematical target, based purely on natural supply and historical parity, is dramatically over $300 an ounce. So $100 is merely the psychological barrier and the starting line for the mania phase. The ultimate peak won't arrive until that ratio compresses significantly and until the mania reaches a fever pitch, where people who have never even considered silver are asking their neighbors for tips on silver mining stocks.
the days ahead are going to be chaotic. The banks will absolutely try to counterattack. They will hike margins again. They'll spread rumors that the mint is reopening with massive supply or that China has paused its buying.
We have to ignore the noise and just watch the immutable data points we've laid out today.
First, watch the vaults. Are ounces returning to JP Morgan? No, they are leaving at a rate of 1.8 million ounces a day. Second, watch Shanghai. Is China selling? No, they are buying and they're paying an $11 premium. Third, watch the premiums. Are dealers lowering their prices? No, they are raising them and they're rationing what little stock they have left.
The fundamentals are locked in stone, driven by physics, counterparty risk, and sovereign necessity. The bridge is burning behind us. There is absolutely no going back to the old world of $20 silver. That world is gone, replaced by a new paradigm of resource nationalism and absolute physical scarcity.
The ultimate confirmation of this entire crisis is the U.S. government itself admitting it has a problem by closing the sales window. They showed their hand. They fear the dollar more than they trust the market. The system is broken beyond repair.
The wealth transfer is accelerating right now, moving wealth from those who rely on paper promises and institutional trust to those who trust the immutable nature of the metal itself.
And if you own physical silver, the events of today just underscore the critical importance of possession. The ultimate lesson of a sovereign default or any system failure is that you cannot rely on custodians.
Do not keep your physical assets in a bank safety deposit. Box banks can, and they do have holidays, and they can certainly suspend access to your box in a systemic crisis.
Keep your strategic assets in your own possession or in a private, non-bank vault where your access is guaranteed regardless of banking hours or sovereign stability. The window for buying physical metal at anything resembling the paper price is closing rapidly. Even at $90 or $100, securing those atoms is a superior proposition to holding paper currency that is actively burning.
The mint is closed, the vault is open, and the price is vertical. Trust the metal.